Hey, good morning and welcome back, options traders. Well, a phrase that you'll hear among professional traders is buying or selling the tail. What exactly does that mean? Well, it's used mostly for spreads, especially your debit spreads, but sometimes traders have either no clue what this means or they'll have an inkling, but they don't really understand the details and why it's important to ask yourself if it's worth buying or selling the tail. So what exactly does it mean and why is it so important for your vertical spreads? So let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with an idea of stocks, and that is the idea of fat tails. And fat tails are really the reason for potentially selling off the tail or for buying the tail. Fat tails are also a reason you have to be really careful about selling naked options. So fat tails really apply to any type of data that has large variations. And what fat tails means is that you've got fewer observations that greatly affect the statistical properties, such as, let's say, the average and the standard deviation. It's just a handful of observations that are really carrying the bulk of the weight. So, for instance, incomes would be an example of a type of distribution that has fat tails. You might have for any given, let's say, a certain area or even a certain company. Let's say at Microsoft, you might look at the average income and say that it's $200,000, and yet you'll find that very few people actually make that. And what's causing this, you've got a couple of people at the top, such as Bill Gates and others, that are potentially making billions. And that's pulling that distribution up. And it's pulling that average up. So that would be an example of a fat-tailed distribution. What about pandemics? We saw this in 2020. You might have a outbreak of some type of, let's say, a flu where it could affect tens of thousands, maybe hundreds of thousands, but it could be into the millions. And so that would be a type of distribution that would have fat tails. Well, it also turns out that stock prices have fat tails. So, for example, let's take a look at Ford. I like using Ford because most people wouldn't think of this as being a real shaker and a mover, like a tech stock or anything. It's a fairly low price stock, so they think, hey, why not sell naked options on it? It doesn't move much. Well, that's not understanding fat tails. So take a look at this screenshot here from E-Trade. Now I know it might be difficult to see here in this red box, so I've just reprinted it up here. And at the time it was showing the current implied volatility was at about 15.5%. Not a terribly high volatility, keeping in mind that the VIX, or the volatility for the S&P 500, usually runs about 20%. The 52-week historic volatility, this would be the actual volatility for the stock, was somewhere between 12 and 47%. Now, 47% is getting some pretty good juice behind it, but you can see that 12 is just about dead in the water. So most of the time you would think that Ford would be a really easy layup to go out and sell these naked puts on, and it starts to look like free money. But what traders don't realize is that stock prices, not just Ford, but stock prices have fat tails. So let's go look at the one-day returns for Ford, at least during the time that this was shot, over a one-year period. And here they are. Now each bar represents the percentage change for that day, but we're putting it in terms of standard deviations. So you can see here is 0. That would just be the average daily change for this stock. Here's plus 2 standard deviations. Here's minus 2 standard deviations. So remember that roughly 95% of all of your data will fall within 2 standard deviations. And just with a quick glance, it looks like most of these bars are falling within plus and minus 2 standard deviations. Exactly what you would expect. But take a look at these out here. Remember, this is all within a given year. The height of this bar here up at plus 6 standard deviations statistically would be expected to occur once every 1.4 million years. The two out here, this is pushing about minus 8 standard deviations. Over here is pushing plus 8 standard deviations. Those types of moves would be expected to occur about once every 1 billion years by just chance. And yet we got three of these extreme outliers in a given year. And this is just Ford. Now, if we look at the same data in a histogram, there you go. Looks like a bell curve here in the center, but look at these tails. Look how wide some of these moves can be. So again, this is why it's very dangerous to sell these naked puts. People look at that and they say, oh, it's got a very slim chance of occurring, and you can pick up 30 cents, sell it off 10 times, and you got yourself some free money. That's not understanding fat tails. All right, so what does this have to do with spreads and buying or selling the tail? Well, again, it usually applies to debit spreads. So let's take a look at a bull spread, for instance. That's where you're going to buy a call and sell a call at a higher strike, but the same expiration. Now, a bear spread would be the same idea in the opposite direction. There you're going to buy a put and sell a put at a lower strike, but the same expiration. So for this example, I'm just going to use the call spread. Let's say that we could currently buy the March $100 call trading for 10. We'd have to spend 10 bucks just for the 100 call. But we could also sell the March 105 call and collect 7. And if we did that, we would have a vertical spread, a debit spread. We're buying the 100, selling off a higher strike call. That's what that definition is right there. So remember, what's making this a debit spread is that lower strike calls must be worth more money. They give you the right to buy the shares for less money. And so that's a benefit. So the market's going to push that price of the 100 call higher than that of the 105. So we know if you buy the 100 call and sell the 105, it is absolutely going to be a net debit. So in this example, it would be a net debit of 3. And that's just the net between these two prices. You're spending 10, but you're collecting 7. So on a net basis, it's going to cost you $3 or $300 per vertical spread. So if we buy the 100 call, sell the 105 call, that would be buying the 100-105 vertical spread for 3. This is the resulting risk graph. There's our bend at the 100 long strike. There's our second bend at the 105. Here's the maximum loss at 3. We know that the most the spread could ever be worth is the difference in strikes, or 5 points. So if you spent 3, the most it could be worth in terms of profit would be 2. So here's your long 100 call, there's the short 105. So far, by buying the spread, we have sold off the tail. We've given somebody else the right to pay 105 for these shares. We're saying, hey, you can have all the gains above 105. I just want between 100 and 105. That's what the vertical spread is saying. But we do have another choice. We don't have to sell off the tail. I could just buy the 100 call, and then I would get this for a risk graph. I would have unlimited gains. And in this case, I am buying the tail. Now, of course, that's going to alter the cost. It's not going to cost us 3 if we want the 100 call alone. So as that previous slide shows, it's actually going to increase the cost to 10. This is really what the decision comes down to. Do you want to pay 10 and include those fat tails? Or do you want to sell off the tails and collect the 7 and have a net of 3? So as a general rule, it's an unwritten rule, but it's a basic idea to try to get at least 20% of that long call's price before you even consider selling off the tail, and most traders just don't do that. So for example, here are some call prices from a pricing model, 30 days to expiration and 20% volatility and 0% interest rates. So you could see that it wouldn't make sense to buy the 80 and sell the 85. That's going to cost you 5, and the most it can be worth is 5. So those options are trading at parity. But could we pay $5.57 for the 95 call and sell off the 100 for $2.29? Sure, that would make sense. Or maybe pay $2.29 for the 100 and collect 64 cents for the 105 strike? Well, 64 cents is 28% of $2.29. So that would at least be in the ballpark. That would make somewhat financial sense to say, hey, look, I reduced the cost of my 100 call by 28%. And at least I got something for it. I got a greatly reduced cost. Now, I did sell off the tail, but I also got a pretty significant chunk off that price. Now, would I consider buying the 100 for $2.29 and selling off the 110 for 12 cents? No, that's only 5% of $2.29. And yet some traders will say, well, hey, 12 cents is 12 cents. You might as well reduce the cost. And they're not realizing that comes at a cost. And the cost is that you are selling off the tail. Is it worth it to collect 12 cents to sell off that tail? Now, the wrong way to approach this is to say, well, it's highly unlikely for the stock to get above 110. Well, of course it is, but that's why they're called fat tails. If it does shoot up there, it might hit 130 or 140. And yet you've sold off all of that potential for just 12 cents. It really did nothing for the amount of the downside hedge. It really just wasn't a good trade. So would I buy the 100 and sell the 115 for a penny? No, that's not worth selling off the tail. Now, as the volatility increases, these spreads can get wider. So let's do the same idea here at 50% volatility, 0% interest rates, 30 days to expiration. So let's say that you wanted to buy the 100 call for 571. Would it make sense to sell off the 105 for 369? Sure. That's 65% of 571. So that would certainly make sense. Now, it might turn out to be a bad idea still to have sold off the tail, but at least you have something to show for it. You got a greatly reduced cost of this $100 call just in case it went against you. But notice that we can also spread these out wider. Would it make sense to buy the 100 call and sell the 115 for $1.34? Well, that's 23% of this 571 cost. Yeah, I would entertain that idea. And again, you don't want to look and say, well, it's highly unlikely for the stock to rise more than 15 points. The question is it worth collecting $1.34 to sell off those fat tails? But beyond that, you'd have to really start questioning it. And yet I see traders all the time that'll do stuff like this. They'll pay $5.71 for the 100 call, and they'll sell off this 130 call for 22 cents and say, well, I might as well get 22 cents for it. It's not a good idea because you're selling off these potentially very valuable fat tails and collecting nothing for it. So the main thing to remember with your debit spreads, the main question, ask if the credit you're getting from the sale of that call is worth selling off the tail. Don't just say, well, 10 cents is 10 cents. Understand that stock prices exhibit fat tails, and that might have a ton of value. And if you're selling it off for nothing, you have to ask, why are you doing it? So remember, the basic rule is to collect at least 20% of the long options price. Are there variations and exceptions? There always are. But that would at least give you some type of a guideline. If you're selling it off for 5 or 10%, you have to really question why. So don't just sell an option just to create a vertical spread. I've heard some traders do that and they'll say, oh, but I want to use a vertical spread. I know that vertical spreads are safer because they have a lower downside risk. Well, possibly. But you don't want to use a vertical just for the sake of using a vertical. We want to use a vertical because it makes sense to sell off the tail. And so the main story is always be sure you're reducing that risk by an acceptable amount. The credit that you're receiving for the sale of that option isn't the only consideration. Always remember, the cost is that you're selling off the tail. And in the stock market, those tails can get really fat. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.